Good afternoon, ladies and gentlemen. My name's Louise Walsh and I'm the CEO of the Future Generation Investment Companies, FGX and FGG. Welcome one and all to our first Future Generation Investment Forum in Melbourne. I want to acknowledge board and committee members here of both companies, particularly Sarah Morgan, who's a board member of FGG, and David Leeton, who's a board member of FGX, our Future Generation fund managers, our Future Generation and WAM shareholders, Future Generation charities, brokers, planners, our service providers and others who are here this afternoon. I'd like to acknowledge the traditional owners of the land on whose land we are meeting today as well. This is the biggest event that Future Generation has done, and we have fantastic numbers this afternoon, and I think our numbers registered even outnumbered the first investment forum that we held in Sydney in May, so well done. We're actually live streaming this afternoon thanks to our pro bono service provider Livewire, and it's also being recorded so that you can view it via the website from next week. Please use the hashtag FG Investment Forum. We definitely encourage social media, especially Twitter. So what's in store this afternoon? Well, firstly, what you're going to hear is 5-minute presentations from 11 of our best performing boutique fund managers in FGX and FGG. They're going to present 1 or 2 stock picks or investment ideas. And just so you know, all but one have actually chosen to present one stock pick this afternoon. It's a bit like speed dating, but it's not one-on-one. It's strictly 5 minutes each, and they will get a warning bell at 4.5 minutes, and it'll be a case of the old red faces, if you remember on Hey Hey It's Saturday, if any of them go over the 5-minute limit. So look out, fund managers. Each fund manager will have 1 slide per fund manager, and they'll get 2 slides if they're presenting 2 stocks. Your programs have some space for you to write notes on the various stocks that you'll hear about this afternoon. The slides you will see from the fund managers won't actually be available after today, so if you're keen, take a photo of them as you see fit and if you think that's what you want to do. There's no question and answers from the audience, I'm afraid. We simply don't have the time, but if you can certainly contact a fund manager if need be on the back of this afternoon via their website, or you can grab them straight after the event if you're lucky. They tend to move pretty quickly, these fund managers. I'd now like to call on the founder and creator of the Future Generation Companies, Jeff Wilson, to say a few words of welcome and to present a summary of the stock pick results from our first investment forum in Sydney in May this year. And I'm guessing that Jeff might even have a stock pick for you himself. So thanks, Jeff.
Great. Look, thank you very much, Louise, and welcome everyone. I mean, it's an incredibly exciting day for us because as a fellow fund manager, it's good to get out in front of the shareholders and tell them, or pick the stock that we think is going to perform. And you may be aware or you may not be aware, there's enormous stress on the fund manager because you all want to win that competition in terms of who's the smartest, who's picked the best stock that's performed the best. In terms of the structure of Future Generation Global and Future Generation Investment Company, it's a very simple structure. And really, it's a win-win-win. And it's very rare in life to get a situation like that. And why is it a win-win-win? First of all, it's a win for the fund manager because they have an opportunity to give back. And all these fund managers you'll see today are managing the money for free. The money that goes into their normal funds and their normal management fee and performance fee, they actually rebate back to Future Generation. Why do they do that? The great thing about funds management is it's a scalable business. And they still all get paid for the money they manage for other people, but for the Future Generation money, they manage for free. So it's a win for the manager because it's an opportunity for the investment community to really support something that makes a difference. The big winners, I believe, are you, the shareholders, and myself. I'm a large shareholder in both entities, entities, because what we're getting access to these incredibly good fund managers. We picked the best and brightest boutique fund managers in Australia and globally that are managing the money on a pro bono basis. And actually, some of these fund managers you actually just can't get access to. Their funds are closed, and you're actually paying nothing for it. There is a cost. Nothing is free, and the cost is the 1% of assets that goes to charities, and that's focused on youth mental health and children at risk. Now, the great deal for the investor is the fund managers charge a lot more than that in terms of management fees and performance fees. So you're actually getting a discount, a significant discount as an investor. And the third winner is obviously the not-for-profits and the charities that are doing this amazing work and really investing back into Australia. So that's the model. In terms of the stock picks, I know last year I wasn't meant to have a stock pick, but I just snuck one in, and I'm embarrassed because I've got the list of the top 10 performing stocks. So fortunately or unfortunately, mine just happened to win. We are shareholders in Afterpay. Anyway, that's the performance, and you could see what we did. That was 6 months ago, so we've actually just doubled. The half-year performance, just annualised the performance, and everyone over a period where in the last 6 months, the market has been strong, but it's nowhere near as strong as this. To me, there were some fantastic results. In terms of my stock for today, I'm going for a stock, actually probably slightly Melbourne-centric, but this is again a high-risk, high-reward stock, and the company is Austock. Now, it's not the stockbroker, they've sold that business. What it is a fund manager. It's got about $2.2 billion worth of fund. It's got a lot of expectation in the share price, capitalised at about $140 million, but it's going through a period of transformation. It's got a new management team. It's got a business that I believe can grow significantly, and it's really, how I see it, it's where Challenger was, say, 12 years ago. It's that type of business. It's a fund management business. Their main area is life insurance bonds, the weird thing is, my first job in funds management was in Melbourne at Scottish Amicable, and that was an area where Scottish Amicable made a lot of money. But to me, that's my stock for the next 6 months, and let's see how we perform. Thank you all for supporting both FGX and FGG, and I think today is going to be an exciting day. Thanks, Louis.
Thanks very much, Jeff. And before we get into it, I want to show you a short video now from Giant Steps, and Giant Steps are one of our FGX charities.
Giant Steps is an organisation that was developed 22 years ago by a group of parents who were looking for an option for their young people with autism. Autism is a lifelong neurological disability. It is probably the most misunderstood disability because it sits in that social communication domain, and that's the major part of the disability. We have a number of corporate sponsors who are incredibly valuable, and particularly corporate sponsors like FGX.
My name is Louise Walsh, and I'm the CEO of the Future Generation Investment Companies. From a non-profit point of view, one of the biggest struggles is finding ongoing sustainable funding. Your average corporate or philanthropic funder might agree to support a non-profit for 1 year, for 3 years, maybe 5 years, but typically they won't make any commitment longer than that. It's quite short-term funding. So what we've done is we've got a group of fund managers together who've agreed to waive their fees. So they're acting pro bono, and as a result of that incredible generosity, we donate 1% of our assets each year to 14 youth at risk charities, and Giant Steps was fortunate enough to be one of those.
The demand for our service is just enormous. And in 2016, the FGX money was that investment that we needed to actually start another school.
It was incredibly satisfying to see our second donation for Giant Steps be put towards seed funding the opening of their Melbourne school. Our chairman flew down, found it incredibly rewarding to be there and to see the bricks and mortar and the start of something special.
Funding from FGX also enables more speech pathologists to work in the schools. It allows us to expand our skills and knowledge. Students that have previously been quite withdrawn have now come to a point where they're starting to initiate more appropriate means of communication. We're seeing kids who are more empowered, and that ultimately leads to happier children.
Corporate sponsors like FGX, they're an invaluable contributor. Certainly they're committed to social investment and actually improving the lives of young people with autism and mental health across Australia, which is extraordinary.
In just 3 years, the total donation has been $500,000. But we don't just want to be a funder. We feel really strongly and passionately about the organisations that we fund, and we'd like to continue with very long-term funding. These companies are set up in perpetuity. So as long as children at risk, youth mental health is an issue in our society or our community, FGX and FGG will continue to fund in those cause areas for way after we've gone.
And that video was very generously made by a production company who have a child who's actually a student at one of the schools. So we very much thank them. And this year, the total donation that was donated by FGX and FGG was $6.8 million. And to date, since the two companies have started, the total donation has been $13.2 million. And these donations wouldn't be possible without the support, the very generous support of our fund managers. So we've got 30 of them in total, and 11 of them you're going to hear from this afternoon. So lastly from me, this is obviously our disclaimer. Rather than you having to sit through 11 different disclaimers from 11 different fund managers, heaven forbid, that might be a bit too much. So I'd now like to introduce our first fund manager, and I asked each of the fund managers if they could give me a quirky fact or two about themselves, so you'll hear a little bit about each of them as we go along. First up, we have Nikki Thomas, and Nikki is the Head of Research and Portfolio Manager for FGG Fund Manager, Magellan Asset Management. Nikki works closely with the lead portfolio manager at Magellan, Hamish Douglas. If you haven't heard much about the Magellan brand, you certainly should be starting to hear about it, particularly if you're a cricket fan. As you're probably aware, they're the principal sponsor of the current Ashes series, and it was certainly great to have a win with the first test up at the Gabba this week. Magellan has $56 billion under management, 110 staff, $4 billion market cap, and who knows what those figures will grow to after they've done this cricket sponsorship. Nikki grew up in country Queensland, so she has chickens, and she gets more excited about her Deere tractor than anyone's fast car. So please welcome Nikki to present the first stock for this afternoon.
Thank you. Well, welcome everyone, and thank you very much, Louise. It's great to be here today. I was actually at this forum in Sydney about a year ago, and we introduced the concept of investing in Apple and also MGE. So I hope you didn't let those ideas go through to the keeper. Today I'm hoping to deal you up another great opportunity, and obviously you can see it up here on the screen. We're going to talk about Starbucks. So let's introduce that business. Starbucks is a $70 billion market cap company. It has over 80% of its earnings coming from the US. It has 26,000 restaurants spread through around 100 companies in the world. and it sells coffee. I noticed as I came in that a gentleman down near the front here was drinking coffee. I thought it would be fun to talk about a coffee company in the city which has probably the best coffee shops in the world, and introduce a brand name like Starbucks, which you all probably think is quite dreadful. So, essentially, coffee is actually a wonderful product to sell, so I think many of you can attest to that. It is a habitual consumption product. Most of us, we drink coffee. We drink it at least once a day, every single day of our lives, and probably more than once. It tastes delicious. It's growing in penetration of beverage occasions. It's a little bit addictive, which is a great thing to have if you're selling products. And of course, it's social. Now, if you're thinking about the social side of coffee, this is actually a very important part of the investment thesis behind Starbucks. Starbucks believes it solves for its customers two need states. And interestingly, one of those is not thirst. So the first is convenience. That's important because if it's a habitual part of your day, you want it to be convenient. And you want to be able to walk past a Starbucks on your way to work or on your way to wherever you're going any time of the day. And they have solved for that convenience in the US with those 15,000 stores in the US. If you've been there, you know you can get a Starbucks anywhere. The second need state that they solve for is actually connection. That's the social piece. That they like the idea of being your third place, the place between home and work, where you reach a social connection. And as we at Magellan talk timelessly these days about technological disruption, the one thing I think you can be assured, apart from the fact that you'll keep eating, that you will not be disrupted by technology with is that you will need human relationships and you will need connection to people. So that social side of the coffee occasion is actually a very important part of the need state which Starbucks are solving. Let's talk about the economics of this business, and the economics of this business model are astonishingly good. This company puts down a new Starbucks restaurant in a market and gets a cash payback on those restaurants in 2 to 3 years. That's a cash payback. We're talking returns on invested capital of 50%. They generate so much cash that their expansion around the world is self-funding, and they continue to pay over 50% profits out in dividends. And then I think it's really about the growth opportunity. That's the last piece of this puzzle that's so attractive. What you see on the chart behind me is some penetrations. It shows you how many Starbucks there are in the world in different markets. So you can see also there are some suggestions around penetration of other brands you'd know quite well, what McDonald's have achieved and what KFC have achieved in different markets as they have built out to more mature profiles. What you see in more mature markets like the US is you tend to have 43 or so of these sort of formats for every 1 million people. In Melbourne, indeed, there's 166 McDonald's, talking about McDonald's. So that's about 43, 44 McDonald's restaurants per 1 million people in Melbourne. So it's a kind of a good number to think about a mature market. I'll test you though, in Seattle, which is Starbucks' home market, their penetration is 1 Starbucks for every 4,000 people. That's over 250 Starbucks per 1 million. Incredible. And it's incredibly profitable in Starbucks. So the penetration potential is huge once you get that incredibly loyal and wedded customer to your business in something that's so habitual. The penetration story is the story of growth. If you think about that story in terms of the US and what they have yet to come, it is amazing. So in China, they have about 5 stores per 1 million people, 1,500 stores today. They hope to have 5,000 to 6,000 in about 5 years' time. Ultimately, of course, the ambition is well north of the 15,000 that they have in the US. And what we're talking about here is decades of double-digit growth with strong cash attached to it. So we forecast over the next 5 years with great confidence that you'll see at least 12% per annum earnings per share growth, probably more than that in terms of dividend per share growth, and you're paying about 20 times today. The history of Starbucks shows a business that's typically traded at 25 to 30 times. So why is it so cheap? Well, there's a couple of things worrying the market today, and you don't need to worry about them. One of them is that the comparable store sales growth in the US has finally slowed down from a ridiculous 5% per annum to more like 3%. a very sustainable number and one that we think will continue to roll forward. The second is that there's a transition going on. That man, Howard Schultz, who I've quoted up there, has founded this company and led it brilliantly. But he stepped aside to be the chairman, and there's a new leadership team in place who've been working closely with Howard for quite some time. So we're transitioning from founder-led to founder-inspired. The market's a little nervous about that. You don't need to be. This is an exceptional executive team, and we've spoken to them many times. So we think this is a wonderful opportunity. Before Louise throws me a bouncer, I'm going to step away. She already told you that we were hosting the Ashes, so I've been usurped on that exciting news. I do hope you're enjoying the cricket. If any of your friends ask you about Magellan, point them to the website or tell them you know us well. Thank you.
So, thanks so much, Nikki, and sorry to steal the thunder there. But it is fantastic that you are doing, I know we're all cricket mad, or certainly I think people are here, so I'm sure they'll be all watching closely, particularly on Boxing Day. I'm definitely not moving to Seattle after that stat. I mean, that is quite staggering, but also I don't happen to drink coffee. So anyway, moving on. So our next presenter is Hamish Chalmers from Watermark Funds Management. Hamish joined Watermark in May this year, so he's quite a newbie to the business there. He covers financials, insurance and real estate investment trust portfolios. Hamish considers himself a Kiwi, but he spent most of his life in England and in Australia. So over to you, Hamish, to present our second stock.
Thank you very much. And let me just say first how thrilled we are to be here. I mean, Watermark is very honoured to be a part of your organisation. The more I learn about it, it's just a really, really great cause. So thank you very much for that. The stock I want to present today is a Aveo Group. I need to click this. There we go. The ticker is OAG. We think on a 2-year view, this stock can go up more than 60%. A bit of context on the business. Aveo Group is the largest, or one of the largest providers of retirement services in Australia. That means they have, at last count, they had about 11,000 retirement beds, retirement units, and about 300 aged care beds. And so they're a developer and operator of those types of assets. The industry is growing. Experts think that in the next 10 years, the compound annual growth rate of demand for these types of services will be about 10%. So the opportunity in the shares as we see it is, in June and July this year, the shares derated heavily on the back of negative media coverage of the retirement charging model, and Aveo in particular. But as we stand here today, roughly 5 months later, we think the business model is more or less undisrupted, and indeed sales rates are recovering back towards where they were before the negative news broke. Before I explain the controversy and the business model, what we think the stock is worth, it's worthwhile just giving you a quick introduction to the charging model, the retirement living charging model. The way that it works is a resident will move into the community. When a resident moves into the community, they buy the unit just as they would a normal house. And it's only when that resident moves out and the unit is sold that Aveo take their fees, which are usually between 20 and 50% of the original purchase price, depending on how long the resident has stayed. Usually people stay about 8 years. The thrust of the negative media coverage at the time was that these contracts are confusing and they're complicated, and there were a bunch of people who essentially, when they figured out how much they were being charged, felt that they had been ripped off. Investors responded to these negative media reports by derating the stock aggressively and worrying about things like contract disputes, mis-selling, litigation, sales decline, and an overall disruption to the business model. So I guess the other thing you would say at this stage is that charging structure, the deferred management fee, is common across the whole industry. It's not just Aveo. And all of the major states have had an opportunity to refresh their retirement legislation recently, and none of them have taken the opportunity to ban the DMF or set maximum limits on charging, or those sorts of things, which we think are very encouraging. So what do we think the stock's worth? It's $2.60 today on the ASX. We think it's worth at least tangible net asset value, which is $3.30 today, and we think $4.10 in 2 years' time, which is more than 60% upside from here. The reasons that we think that it's worth net asset value is, first and foremost, the stock traded through at a premium to tangible net assets before these negative news stories broke. And as we said, we think the business model is more or less undisrupted. The second reason is Lend-Lease last month sold a 25% stake in a very similar portfolio at a premium to tangible net asset value to a Dutch pension fund. We also know as part of that process there are a number of other foreign interested parties looking at that Lend-Lease portfolio that presumably have a similar view on valuation. And the third thing that we would say is there's actually reason to think that tangible net assets is actually a conservative valuation target. The reason for that is the best economics in this business are created when the business develops and sells the units, as opposed to actually owning and operating the facilities, which is a much lower return on capital enterprise. Now, the company knows that, and they're trying to orientate the business model in that direction, more towards development. The poster child for that business model is a New Zealand business called Ryman, which is a similar business, but they've done a much better job at development. Now, Ryman trades at 2.5 times tangible book and has returns on assets between 8 and 9%. Aveo trades at 80% of tangible book and has returns on assets between 4 and 5%. In addition to the NAV re-rating, which I've described, the reasons we think that will occur, NAV also grows very quickly as Aveo is rolling its existing and new residents onto new style contracts. So as we all know in this room, a cheap stock is better with a catalyst. We hope that in the next 6 months, the company will start buying back its shares after it sells its last remaining commercial real estate asset in Brisbane, which should unlock about 8% of the market cap of the company. So in summary, we think we have a stock here with a very clear path to more than 60% upside. And given the discount to the stock, we think there's a very large margin of safety for things to go wrong. Thanks very much.
Thanks so much, Hamish. Now, next up, we have Douglas or Doug Tynan. He's from our FGG fund manager, VGI Partners. Doug has over 13 years' experience as an equities analyst and also an accountant. We'll forgive you for that latter. He is a director of VGI Partners Global Investments, VG1, which listed recently and raised an incredible $550 million. Congratulations, Doug, to you and the team at VGI. It was an awesome result. And now for Doug's quirky fact or two. He has a commercial licence to drive a taxi in Auckland and a forklift, but he does not own a car. Anyway, I think that's probably a cracker of a quirky fact or two, and it'll be hard to beat this afternoon. And here's Doug.
Thank you, Louise. The company I'm going to talk to you about today is WD-40. Yes, the maker of this famous WD-40 industrial lubricant can. Now, please raise your hands if you do have a can of WD-40 at home. Excellent, a lot of customers. So just in case you don't have a can at home or you'd like a second one, if you see Alexandra at the registration desk, we've got a number of these out there for you, pocket-sized, purse-sized cans. So please take one. So WD-40 is a product that can do it all. From loosening rust, loosening a bolt, removing rust, or de-squeaking a hinge. This product also removes chewing gum from hair. The next time you're fishing, try a little spray on the worms or your lures and see the results for yourself. The WD-40 product is used in homes around the world, but the real customer is the tradesperson or mechanic who never leaves home without a can in their bag. Now for a little bit of history about this product. The WD-40 product was invented in 1953 in a small laboratory in San Diego, California, where their head office is today. The scientists working on this project were trying to make a spray to stop the outer skin of rockets from rusting. The name WD-40 stands for Water Displacement 40th Formula, as it was the 40th attempt that perfected this little can of spray. Now for a little known fact. WD-40 is actually scented. What you smell when you spray this product is not a natural odour. This is a perfume that has been specifically designed to make you remember that it is WD-40 you're using and no other product or imitation can smell the same. Whoops. Not only is this a great product, it's a terrific company. Today, the WD-40 company has annual revenue of nearly $400 million US dollars from selling this simple product in 176 countries around the world. The WD-40 company has a market capitalisation of just 1.6 million US dollars, so relatively small, with almost no net debt. Now for the business model. WD-40 has an asset-light business model. The company manufactures the WD-40 concentrate or syrup internally and then outsources the manufacture of this can to external fillers and canneries around the world. WD-40 focuses on the highest return part of the production process, which ensures that their secret formula is kept in-house and allows them to specialise in what they do best, which is brand marketing. Put simply, WD-40 buys commodity products like oil and other chemicals and mixes them into proprietary formula. It then puts the famous WD-40 badge you can see here and everyone recognises on the can and sells a high-quality branded spray. This means that WD-40 has limited capital requirements and needs just 448 employees globally. That's 448. Only 2 of these employees are actually in manufacturing. As a result, the business is highly cash generative and has the ability to return almost all of this cash to shareholders in the form of dividends and share repurchases. WD-40 has delivered stable long-term growth as its product gains wider distribution in new markets such as China. We don't see this changing in the future, this growth profile. It doesn't matter how far the internet and digital technology extend into our daily lives. We think there's always going to be a place for a product that stops rust and eradicates squeaks. WD-40 is also at the very early stages of creating exciting brand extensions. We see the product range expanding substantially over the next decade to address new markets and consumer needs. For example, WD-40 has introduced new products which are specifically designed for cyclists, including chain lubricant and boats and gardening equipment are other opportunities. These new products are much higher margin too because they're able to sell to cyclists at a higher price. So we see their gross margins going up over time. Not only do these new products help to drive top-line revenue growth, but they also generate higher margins as they sold at premium price points to discerning users. On top of this, we believe that WD-40 could make an attractive acquisition target for a larger consumer products company. Our analysis of similar transactions suggests that an acquirer could afford to offer a significant premium to the current stock price. But we don't own WD-40 stock just for its takeover potential. The company is an attractive investment today for investors with a long-term investment time horizon. Now, in closing, WD-40 is a great example of what we look for at VGI Partners. It has been a consistent long-term performer, which we believe will continue to compound earnings into the future and deliver attractive returns for shareholders. WD-40 has been a core position of VGI Partners' portfolio for 7 years now, and you'll be glad to know that every time you spray this wonderful product, you are generating a smaller amount of return for your future generation investment, as well as the charities that it supports. So I'll spray. Thank you.
Oh, there is a bit of a smell up here, I must say. Oh, it's quite strong, actually. Thanks so much, Doug. That was fantastic. And I didn't know about those, extra products. I know someone like Jeff Wilson's a big cyclist, and I'm sure there's probably a few others here. So I'm sure they'll be onto that if they don't already know it. But I think we all love a bit of a freebie. So make sure that you grab some of those cans on the way out. I'm not sure we've got one for everyone, so it'll be best in, best dressed. And I know my husband will be keen for me to pick up an extra can. Yeah, thank you. I'd now like to introduce our next presenter, and it's David Prescott, who's the founding director of Lanyon Asset Management. They're a value-oriented equity fund manager established in 2009. Lanyon is one of our incredibly generous FGX fund managers. Perhaps the only thing that Dave loves as much as finding a good value investment, other than his family, of course, is seeing his beloved Port Adelaide AFL team winning games of footy. Now, I'm not sure how well that's going to go down here, Dave, in the home of AFL in Melbourne. Dave has presented at the first two Sohn Hearts and Minds investment conferences in Sydney, as well as our first Future Generation Investment Forum in May this year. So he's a man in demand. We are curious about what stock pick Dave's got in store for you today. Thanks, David.
Thanks, Louise, and hi everyone. It's a genuine privilege to be involved with the Future Generation Investment Companies, and we're really pleased to be here today. I'm going to start with a little video, if I may. Hopefully this works.
Emergency services, what is the address that you need the fire brigade to go to?
Flat is 805.
Yep.
And the address is 673 Latrobe Street.
In what suburb or town?
It's Docklands.
The Docklands, 802/673 Latrobe Street.
Our first reaction was, how the hell has this happened? You shouldn't have a combustible product on the outside of a building of this type.
Oh!
So how has this been allowed to happen?
We have a fire in a multi-storey apartment, multi-storey building. Fire is on the 3rd floor, extending up to the 10th floor, going along the balconies. We have a huge amount of smoke and fire on the building. We have multiple people inside the building.
If it wasn't brought under control in a pretty quick amount of time, they could claim hundreds of lives. There's no doubt about that.
Yeah, a few hands up, a few nods in the audience. So that was the beginning of a Four Corners report that was aired last month. What this report goes, report goes on to demonstrate is there's been thousands of buildings built in Australia with a highly combustible, non-compliant and completely safe aluminium and polyethylene cladding. I won't go into today why the building industry has used this product so extensively. That's $1 million question. But what I can say is this cladding product has been used widely in apartment buildings, in office buildings, in hospitals and in schools. Later in this report, the question was asked exactly how many buildings have been built with this product. The answer that was given was the number is unquantifiable. When asked again if that meant thousands, the response was this will mean more than thousands. This is a huge issue for Australia. Aluminium cladding has been used extensively across the Australian building boom. It has been described to us that this issue is as big as the asbestos issue, or it's the asbestos issue of our generation. The building industry is currently going through nationwide audits and potential building code changes. Whilst any building code change is unlikely to be applied retrospectively, we think, or in our view, insurance premium increases will likely force extensive cladding replacement to occur. So why am I talking about this today? The company I want to introduce today is Global Construction Services. Despite the name, the company is not global at all. It is purely an Australian-based construction services business. It is ASX listed, and it's a commercial services business. The company has a current market cap of around 170 million, and we think it's very much under the radar. GCS was historically a pure Western Australian business focused on commercial construction projects, resource sector maintenance, and residential projects. The company leveraged its balance sheet and bought some assets at the wrong time of the cycle. Significant write-downs followed, and it's fair to say the company fell out of favour with the broader share market. This is reflected in the share price performance as shown in the chart. However, The company recently sold its capital-intensive and loss-making, so it's a business that was actually losing their money, for $29 million, restoring the company to a significant net cash position. What we don't think the broader market has realised with this specifically is that sale of that previously loss-making division has crystallised significant tax losses for GCS, which will shield the company from future cash tax payments for the next 2 to 3 years. This will significantly boost free cash flow. GCS is one of the nation's leading cladding businesses, a company that specialises in the installation but not the manufacture of cladding facades and will most surely benefit from any widespread cladding replacement. The industry is highly specialised and concentrated with only a very small number of experienced participants. Cladding is certainly not GCS's only business. The other businesses include scaffolding, it has a formwork business, it has a commercial services division, and it has a national, now not purely Western Australian footprint. But we think the cladding business has a very, very strong growth profile and will be a meaningful contributor to earnings growth over the next few years. We think the broader stock market is awash with overpriced stocks. GCS in this market is currently trading on a forecast single-digit PE multiple that's single digits. We think that is extraordinary for a company with a net cash balance sheet, a company that won't pay any cash tax for potentially 3 years, and for a company that we expect will pay us a growing stream of fully franked dividends. We expect strong growth in earnings here, some due to the material cladding opportunity and some due to the general uptick that we can see in business activity in national construction markets. We think this company is deserved of a market re-rating and multiple expansion. The current stock price is kind of mid-80 cents. Our estimate for value for GCS is well over $1.20 a share, implying over 50% upside from the current price. Thank you.
Thanks very much, Dave. Fantastic to have you up there. And it was very powerful, I must say, having that video to introduce the stock as well. I'd now like to introduce Andrew Bod. And Andrew covers the global consumer sector for Antipodes. And prior to working at Antipodes, he was at Platinum. Incredibly, in just under 3 years, Antipodes now has over $6 billion of funds under management, a phenomenal start by Jacob Mitchell and his team at Antipodes. Now, a couple of quirky facts about Andrew. He was quite forthcoming, which was very good. Andrew started doing ballet bear exercise classes at age 37. He's still the only male in his class, but he tells me that he's not complaining about that. Second quirky fact, Andrew recently had his first child, and when his wife was 6 months pregnant and complaining about feeling like a whale, he did what any thoughtful husband would do. He took her swimming with whale sharks at Ningaloo Reef in WA. The only trouble was she spent the trip vomiting from seasickness. So it's the thought that counts, Andrew. So please welcome Andrew.
Thank you. Okay, there we go. Thanks, Louise. Hi, everybody. Now I'm going to talk about a stock that I suspect most of you have actually never heard of, and that stock is called KT Corporation. But if you think of Telstra in Australia, KT's origins were just like that. It used to be the government-controlled telecommunications company in South Korea. And for us, so today, its business is still, servicing mobile phones, telephones, and also broadband fibre networks in South Korea. And this stock has recently become one of our top 10 holdings in our fund. If you look at this chart on the bottom right, the light blue and the dark blue, you can see that's almost over a 20-year period. They're both trending downwards, which is a pretty miserable outlook for the stock and the chart. And that's come about because the market is extrapolating, again, a pretty dire outlook for this business. And that's because it's concerned about a couple of major risks. If you look at telecommunications companies around the world, they tend to have this habit of spending a lot of money. They're always having to upgrade their networks, build the network, upgrade it, and then keep adding new technology. And the market is concerned that KT is going to do something similar. The other concern it has around risk is on regulation. There's some fear potentially that the Korean government / regulator might step in and want to control some of the customer pricing that they're giving out for the customers. At Antipodes, we don't agree. We think the market is overstating those risks, and therefore that's why we've put it into one of our top 10s, and we think it's actually being more than factored into the stock price. With Antipodes, to build an investment case, to be able to get it into the portfolio, you need to be able to come up with multiple ways of winning, which is underwritten by a large degree of margin of safety. Again, we think KT has both of them. So I'll give you some of the examples of the multiple ways of winning. First up is consolidation. In Korea, it's only a 3-player market, and it has oligopoly characteristics, and that's evidenced by the fact you can see the churn rate of customers is actually very low and has been low for quite a while. So in other words, those 3 players aren't out there cutting each other's necks off, trying to undercut each other on price. They're actually behaving sensibly, because otherwise if they do that, everyone's going to suffer, including the shareholders. The second way we think we can win is on monetisation. So I raised some awareness earlier on about the risks around capital expenditure. We don't think that's there because KT has already covered more than 80% of the South Korean population with a fibre network. And the other issue on CapEx is also on 5G rollout. We know that's coming across the world and it's happening in Korea as well. But the key point about 5G is that it's not going to cost as much as what the rollout for 4G did, because most of the infrastructure, the core infrastructure, is now in place, including the mobile towers and the densification assets that they need to implement. So just to make that point, we think the bulk of the CapEx for this business is sunk. We're not worried about future spending the way the market is. Another point, an interesting point we think we can win on the stock is through real estate. Given the heritage, the long heritage of this company and the government control it used to be under, has actually got a lot of legacy assets on the balance sheet, land assets. And it's already doing it and will continue to do in the future. It's developing those assets into shopping centres and apartments. We think that we can estimate roughly that land value could be worth $7 billion, which is the whole actual market capitalisation of the company today. The final point I want to make on ways we think we can win is we've observed other telcos around the world in different regions, different markets. Once they actually start paying out more of their profits, more of the cash that they're generating, they tend to get re-rated by the market. So for example, if you look at Taiwanese telecommunication companies, they pay out close to 100% of their profits in dividends, and the market is putting them on a 10 times EBITDA multiple. Compare that to KT, it's paying out 30% today, and it's been put on a 3 times EBITDA multiple. So you can see the potential for upside if it starts to pay out more of those cash earnings. So having outlined some of the multiple ways of winning, we also need the margin of safety. We think that's there in spades. The fact that it is already generating cash today, which equates to about a 15% free cash flow yield, which in today's worlds of near zero rate environment looks pretty good when you're considering investors are chasing, yield chasing around the world. And if you slice and dice KT valuation up in any way, it always comes up cheap. It's one of the cheapest telcos in the world, and that's inside a sector globally. The telecommunications sector is also very cheap and unloved relative to the rest. So one of the final things I'll leave you with is just to think about. So KT, it's servicing 50 million population in South Korea with fibre. That fibre speed is running at 100 megabytes to 1 gigabyte per second. Compare that to the NBN in Australia. NBN is probably going to cost over 60 billion. It's trying to service a population of 23 million, and you're getting speeds of 25 to 100 megabytes per second. So it just goes to show KT's not bad. It's priced at 7 million, servicing double the population at speeds of 10 or 40 times faster than the NBN. So we think it's actually a pretty good company. Thank you for your time.
Thanks very much, Andrew. Fantastic. Now I'd like to introduce Matthew Kidman. Matthew is the Principal and Portfolio Manager at Centennial Asset Management, one of our FGX fund managers. Prior to that, Matthew was a portfolio manager at Wilson Asset Management for 13 years. So I've actually had no trouble uncovering several quirky facts about Matthew, and probably too many for his money. He's a country boy from Leeton in regional New South Wales. He's an obsessive Sydney Roosters fan, I hear. That might be the wrong code for down here. He's a lawyer turned journalist turned fund manager, which is highly unusual, and he recently completed his PhD on does an ageing population impact house and equity prices in Australia. He's written 4 books, 2 of them with Jeff Wilson, and one was on management and the 10 best performing stocks over a decade. And the common thread I hear in all of that was that the managing directors or CEOs all came from regional or rural Australia. Over to you, Matthew.
Okay, thanks very much. Thanks, Louise. Just a couple of things. I was around when Jeff started to think about Future Gen and put in an amazing effort to get the 2 vehicles up, and well done for supporting it. The idea was there for a long time, and it was incredible how it unfolded, and luckily I'm involved in it now, so thanks for that. I'm going to take you right down to the grubby end of the small cap market, where I operate in, or Centennial does, and talk to 2 stocks. One of them up until today, or one of them still is a good suggested buy. The other one was good until yesterday, and something went wrong, but we'd already put it into the program. So I'll tell you what happened there. Here we go. HRL. The HR stands for Hot Rocks. I remember Jeff and I doing a presentation years ago, and someone said, "What do you think about Hot Rocks?" And Jeff's face he didn't know how to answer that. But it's morphed into something else. Hot Rocks is not the flavour it used to be. Now, it's as it says up there, it's a diversified environmental geotech service provider, which basically means it tests a whole bunch of things. Soils for various hazardous chemicals like asbestos and so on. It also tests for building sites. Now, it's an interesting company because it was got hold of, the Hot Rocks shell was got hold of by Kevin Maloney, who was the Mac Group a few years ago, sold out. It was a listed company, did mining, housing construction, and Kevin walked away with about $300 million, and lo and behold, he's got hold of this vehicle. And he put a whole bunch of these hazardous chemical testing businesses in, and to be honest, over the couple of years that they've done it, it's gone backwards. It's been a disaster. They've spent far too much, and they've lost a lot of their earnings in that couple of years. Up until what made it interesting, earlier, a couple of months ago, they went and bought a business in New Zealand called Analytica. And Analytica is a much improved version. It's got laboratories around New Zealand, and it tests for a variety of things, but mainly food. So it tests what your honey's like. It tests what the milk is like in New Zealand. It also tests for other things like timber, and it does the environmental testing for various grounds and soils and so on. And strangely enough, it does methamphetamine testing as well. So why do they need to test for that in New Zealand? Is that methamphetamine users in a house, when they go to leave and someone buys the house or wants to rent it, the drugs somehow get into the wall and the carpet and can make people moving in sick over a period of time. So they've got to be tested, and that's a booming industry in New Zealand and starting to come about in Australia. So we think that's a great acquisition. We think there's a lot of growth. There's double-digit growth. The multiples you're paying are about right. There is risk because it is a new vehicle, but they can expand Analytica into Australia. And the last thing they've got a 26% shareholding now in a testing company that tests foods going out of New Zealand and Australia into China. So if you're going to sell your food into China, you need to test and it meets the standards over there. All the testing has been done in China. They own a 26% share in the first lab that is outside of China, which is very attractive to Australian and New Zealand businesses. So we think that's worthwhile looking at. Quickly on the one that's fallen flat, Capital Health. And I picked this because, one, we own it, and two, it's a Melbourne-based company. I thought it was appropriate. It was the local flavour. Capital Health is a leading provider of diagnostic imaging. What does that mean? MRIs, CAT scans, X-rays. They own clinics all around Melbourne. And they mainly generate their income from people using their Medicare payments. And the stock was a big high flyer a few years ago. They overgeared. New management came in. They fixed up the gearing problems. They sold a lot of their assets. They got it back. They reduced the cost. New management came in. And it all lined up. They recapitalised the company, and that's where we came into it. And then they did a lot of good things. They sold their biggest asset that wasn't earning much money, and all of a sudden they had net cash of about $80 million, and it was this little company. They still had all their assets in Melbourne and a few around Australia, but they sold their Sydney assets and got a really big price. They went from there, buying back their shares, terrific, and then they said, we can use that cash not only for buying back our own stock and giving you a special dividend, but we can buy selective small imaging centres around various places, including Melbourne, for reasonable multiples. Those reasonable multiples, 4 to 5 times EBITDA, and they were trading on 7 or 8. So it became quite a good use of the balance sheet. And we thought that tells us it's worth about 40 cents, which when we're talking about 29, 30 cents. So, and they actually stated that. Until yesterday, they stuck to that plan, and this gives you a reason why equities are always risky. That instead of buying those smaller add-on, bolt-on acquisitions for those cheaper multiples, they went and bought another listed player, and they paid 11 times EBITDA. And it can only work now if they get a lot more synergies from putting them together. Synergies meaning you can reduce the cost. So we thought it was worth 40 cents. It's interesting, they spent a big number. They've used all their cash. They've gone into debt, and they've paid 11 times EBITDA. And I thought, will I put it in or won't I? And I decided I'll keep it in because it tells you how risky a business can be. Now, I'm not saying it's worth dramatically less than what it is today, which is around that 29, 30 cents. But the upside I was talking about is dead in the water for quite a while now, all because all the good capital management issues that they had put in place before by selling their underperforming assets and reinvesting that in better assets has kind of lost its way in one fell swoop. Now, it's an aggressive bid for Integral Diagnostics, which is another listed player. You might have read about in the paper. And it might not happen. But at the moment, they've got agreement from 4 fund managers to get 20%. So you'd think they're a pretty good chance. From that point, we went from a buy to a sell on the stock. So we sold stock yesterday. So I couldn't stand up here and tell you anything different. So sorry about that. So there's 2 stocks, one good, one not so good. Just on the quirky facts, yes, Sydney Roosters fan, but also growing up in the Riverina, I'm a Hawthorn fan, and I'm just as diehard. So you might even hate me even more for that. Thank you.
Thanks, Louise. Thanks, Matthew. I'm glad you revealed that about Hawthorn. And thanks for leaving in Capital Health as well. Fantastic. So next up, as you saw earlier, Jack Lowenstein from FGG Fund Manager, Morphic Asset Management, was one of our star performers at the May Investment Forum. He came in 5th there. And we couldn't not invite Jack back again. He co-founded Morphic in 2012, and he was previously the Deputy Chief Investment Officer at Hunter Hall. Earlier this year, Jack and his team set up a new ethical fund at Morphic as well, so he's had quite a busy year. You can see Jack down at Bondi Beach, actually, regularly playing volleyball. Even Twitter knows about it, apparently. We also got some fabulous coverage after the May Investment Forum, and part of that was 2 stories that Jack featured in playing volleyball down at Bondi Beach. At the May Investment Forum, Jack threatened to wear his bungee smugglers, his Speedos, on stage today if he topped the stock pick results. So thank goodness he didn't, actually. But anyway, look out. Here he is, Jack Lowenstein.
There you go, my note. What a relief it is not winning, eh? Well, you know, you're still going to get some shorts. I'm here to tell a story about a dot-com survivor that's become one of the most innovative banks in America, Bank of Internet. I'll also tell you a little bit about how dodgy some share price manipulation can be in the US and short selling. And lastly, talk about how shorts can just be too tight. but don't we all want to be Warwick Capper anyway? So Bank of Internet was a company that was founded to try and transform banking in America from old-fashioned branch banking to branchless banking. And it's kind of an overnight sensation over 17 years, listed just before the dot-com bubble burst in 2000, and it's done very well, but it has been a long grind. It's also highly controversial. So I want to make this very clear. At Morphic Asset Management, we're very risk-focused, so this is only a 2% weighting in our fund, not our largest position by any means. And if you do have an interest in it, for God's sake, don't buy a lot. The reason why it's so controversial is that because it's doing something different, which is internet banking or online banking, lots of people want to look at it and say, it can't be true, it must be a fraud. And so it has been exposed to a number of what are called short side attacks. So short sellers will go and short the stock, and then they'll go and publish some specious story about some scandal, which actually has proven to be untrue over the last 5 years that we've been following the stock every time, and then hope the stock goes down. So it means it's very volatile. Having said that, it's up about fourfold since we first started looking at it in 2012. So it has done quite well, but with high volatility. The US banking industry is very different from Australian banking. There are thousands of banks in the US, and there are about 150 that we look at, which are in our plus 400 million US market cap range. And frankly, it's a very boring industry. The industry is growing at about, its loan growth in the US is about 3% a year across the whole system. But some of the regional banks are doing very well. We own this one, plus we own Bank of the Ozarks and Western Alliance, which is based in Arizona. And the reason we like them is because they can grow quite fast, even though the industry's not going fast. And we actually short Wells Fargo to take out all our US banking risk against those positions. Now, this stock is cheap. It's on a P of about 11 times, which for US regional bank is very cheap, particularly given it's one of the most profitable banks in the US because it has no branches. It has an ROE of about 17%. It's been growing at about, it's been growing EPS at about 25% a year for the last 4 years. And it'll probably slow a bit because it's now up to nearly $10 billion in assets. And when banks get that big, they're subject to a lot more regulatory pressure. They have to do a lot more reporting. So its growth will slow a bit for the next few years, maybe 15% a year, I would guess. Well, that's my estimates anyway. But let's talk about the shorts now. So this stock is 80% owned by institutions. The insiders keep on buying shares, that's the staff, so they obviously believe in what they're doing, and yet it's one of the most shortest stocks in America. How shorted? If every short decided to buy back his short positions and they bought every share that turns over on a normal turnover, it would take them about a month to get out of their positions. So we're very excited about this because what it means if we're right and all these rumors that they keep on spreading are wrong, and they've been very, very, I mean, as I say, I've been looking at it for 5 years, and every rumor that's been put out there has proven to be false so far. If we're right, when the stock starts to go up, it could do very well. It could easily double in a year. And the reason why we think that's going to happen, by the way, is not only all these rumors proving to be false, there haven't been any new ones for about 18 months, but also the US small cap banking is going to do well because it's going to benefit from any tax cuts that come through, which will automatically improve their earnings. And also, as interest rates rise in the US, their margins should pick up. This is quite a profitable business, by the way. They have about a 4% net interest margin, which by US standards is pretty good. So we're quite confident in that. And as I said, shorts get squeezed. Shorts are often wrong, and when they get squeezed, it's really good fun to watch if you're long the stock. Because what happens is they have to climb over each other to buy back all the shares they've sold. But as I said before, it is a high-risk story. Please don't bet the farm. I'm going to stop there. No bell.
Okay, thanks so much for that, Jack. It's a bit scary looking at that photo of Warwick Capper, I must say, though. George Coleman co-founded FGX fund manager Arco Investment Management, originally Optimal Australia, in 2008. George worked closely with the founder and creator of FGX and FGG, Jeff Wilson, early in their careers when they were both equity analysts. That was over 30 years ago, and I bet the two of them have had some wild stories and tales that they could tell about each other, working and playing, I bet, George. George tells me that then, as now, Jeff had tremendous energy, both on and off the field. Sounds intriguing, George, as I'm sure your stock pick will be. George, I thought the quirky fact was meant to be about you, though. Anyway, over to you, George.
Good afternoon, ladies and gentlemen, and thank you, Louise. If I'd been asked 30 years ago, is Jeff Wilson the kind of guy who can stack out a forum like this with 2,000 people, I would have said, yep. I'd like to acknowledge the great work that FutureGen is doing, and in a similar spirit today, I want to focus on an investment from which we not only expect great returns, but where those returns have a clear connection with the social need and with social change. At ARCO, it saddens me to say we don't have an awful lot of stocks in the social good category. We do limit our sub-ASX 200 exposure to under 10% of fund NAV, and we don't typically get involved in small cap bioscience at all. We happened to stumble across this company, Brain Resource Company, or BRC, some years ago when we were busy short-selling AMP, and we were trying to better understand how it was that AMP was losing so much money on writing income protection insurance. A large part of the answer to that was, and still is, mental health disability claims. And these claims, and mental ill health in general, are a massive insurance problem. The APRA statistics tell us that the Australian insurance industry has lost over $1.5 billion on retail income protection policies in just the last 4 years. In the US, which is this company's real focus, mental ill health is rightly described as epidemic and is costing insurers and corporates something like $200 billion annually. This is not only a hugely expensive societal problem, but one which is pervasive at all levels of society. Just look at the White House, for example. To our surprise, this obscure little company, Brain Resources, has spent as much money on brain science R&D as anyone has globally, at something like $70 million over the last 15 years to develop its two key scientific assets. And those are, first, a standardised digital brain assessment and training platform, and second, a huge proprietary brain function database with over 1 million data sets gleaned from over 600,000 individual assessments, and that's growing at about 20% per annum. So $70 million, these guys have certainly burnt a lot of cash, but the question is, do these assets have any real commercial value? Well, BRC has not done a great job on commercialising its science, but they have managed to attract a very high-quality customer base. At present, they have 5 major insurance partners with coverage of almost 200 million American lives, and they have 28 corporate clients under licence, mainly Fortune 500 names like Nike, Citrix, Accenture and Boeing. So that customer base and the performance statistics which they quote, which I believe are eye-catching, seem to say that they have something very real. So now let's look at that stock price, and that's a disgusting stock price. It's completely horrible. So in our view, the company was somewhat spoiled by its early success. In its early years, they grew very quickly, and by 2009 and 2010, they were generating around 10 million in annual revenue and around $2 to $3 million in EBIT. And a very large European pharmaceutical company came along and paid them almost $20 million cash up front to run a massive depression drug trial using their database. From that point, even though BRC has gotten its foot in the door of that impressive client list, management has failed to execute. In addition, the company's had a terrible capital structure with a big chunk of senior secured bonds with a downward equity conversion ratchet. So what's changed? And the answer is pretty much everything has changed. But to highlight quickly 3 key things, a year ago, a very experienced venture capitalist, Matthew Morgan, was appointed to the board with a mandate for change. In the middle part of this year, we saw a massive upgrade of senior management with 4 US-based executives joining as CEO, CFO, Chief Operating Officer and Head of Revenue. And then this last month, the company has raised $10 million in equity capital, and they've also converted the convertible debt held by Oxif into ordinary equity. So there's now just one class of capital. These people are a very well-credentialed management team. Time precludes a fuller description, but the new CEO, for example, Louis Gagnon, is a tech industry veteran with over 25 years' experience at Amazon, Yodel, Monster.com, and he was most recently a senior executive at TPG. Gagnon and his team have a completely different skill set to the old BRC. They have very deep experience in the rapid scaling of digital and SaaS-based business platforms, in marketing and in fulfillment. An A team like this doesn't come cheap, of course, and management have been granted equity participation, primarily through at-risk ESOP grants, over 20% of the company's diluted capital. So these guys are very, very well incentivised. Now, BRC doesn't get the $10 million next month, but the new business plan is already very clear. The commercial focus used to be unidirectional, and it's now very narrow, centred on driving adoption and yield within its existing insurance, those 200 million lives covered, and corporate clients who are so worried about the cost and performance of their human capital. Execution in a company like this, which is inherently high risk, is everything, of course, but BRC has a hard science base lacking in competitor offerings. The new business model is SaaS-based and highly scalable and more than capable of supporting a high EV to sales multiple as growth begins to accelerate, as we believe it will do over the course of the next 12 months. Thank you very much.
Thanks very much, George. And I really do like the mental health connection, I have to say, particularly because it's the focused charitable area of FGG. Our next presenter is Mark Landau, who's the co-founder of FGX fund manager L1 Capital, based here in Melbourne. We're delighted to have added L1 as a fund manager for FGX about 12 months or so ago. Mark is travel obsessed. He's visited more than 60 countries, which is quite amazing, including the likes of scuba diving in Honduras. She's checked out gold mines in Senegal and whitewater rafting in Zambezi. So he does know how to switch off when he can. So please make Mark welcome.
Thanks, Louise, and thank you all for coming, and thank you for supporting such a fantastic cause. Last year at the FGX conference, I was quite controversial. I recommended all of you go out and buy some shares in Qantas. And at the time, I could see everyone rolling their eyes, saying, why would I go and buy an airline? You clearly don't understand what you're doing. The stock has proven to be a fantastic performer. It was the best performing stock in the ASX 100 over the last year. The other recommendation I had was to go and sell your Telstra shares and buy some Macquarie Atlas, which is the best toll road network in France. Telstra shares are down 33% over the last year. Macquarie Atlas is up exactly the same amount, 33%. So today I'm going to stay just as controversial, and I'm going to stick with something just as unloved. Today, most investors I speak to are frustrated that every stock they look at seems to be on 20 or 30 times earnings. People can't seem to find value out there. So what if I told you today that you can buy a fantastic suite of assets for 1 times earnings? 1 times. Or if I told you could buy one of the best companies in all of Australia for 0. I bet you think I'm a liar, but it's true. The stock I'm going to recommend to you today is News Corp. Many of you probably don't remember News Corp because this is the little offshoot from Rupert Murdoch's Fox Group, which is listed in the US, and this is the smaller brother called News Corporation. If you look at the screen on the left-hand side, you can see that News Corp's market cap today is around $12 billion. That valuation is easy to get to. Let me explain how. News Corp owns a 62% stake in REA, which based on today's share price is worth roughly $6.4 billion. They own an 80% stake in Move, or Realtor.com, which is the second largest online property portal in the US, a competitor of Zillow. That business is valued at just over $2 billion. News Corp also has a lazy $2.3 billion of cash on the balance sheet, or as they announced last week, it's actually $2.5 billion now. Those assets in combination come to just under $11 billion compared to a $12 billion market cap. So where's the story about the 1x earnings you were talking about? If you look at the assets on the right, there are more than a dozen assets, household names that you would all know. The New York Post, the Wall Street Journal, Dow Jones, Barron's, etc., etc. The combined EBITDA of all of these assets is $1.2 billion. The market value implied in News Corp's share price for those assets is exactly the same number, $1.2 billion. So you can buy these assets today at 1x earnings. Unfortunately, when I started doing this slide, it was a negative number. You could have paid less than zero for this earnings. If you want to think of it a different way and you want to say, what's the story about the free business you were saying? You could put the assets on the right-hand side of the page on 6x EBITDA, which, as I'll explain later, is a conservative valuation. If you did that, you're getting the entire $6.4 billion stake in REA for free. So, if the stock is so obviously cheap, why is it trading at this share price? Well, there are 5 myths about News Corp. Myth number 1, News Corp is an old media business. You ask any person about News Corp, the first thing they say is, newspapers and book publishing, they're finished. Incorrect. The vast majority, as you can see on the slide, the vast majority of the valuation comes from the online property portals, like REA and Realtor.com. These are fantastic assets. They're growing fast, they require little capital to grow, and they operate in rational duopoly markets. Every year that passes, the digital assets on the left-hand side grow faster than the traditional assets on the right-hand side. And that gap between the fast-growing assets and the slower-growing assets is only getting more extreme. Over time, the assets on the right-hand side will be a very small part of the overall valuation. Also, the assets on the right-hand side, the traditional assets, are becoming much more digital. If you think about book publishing, despite the fact that an e-book costs less to buy than a traditional book, it's more profitable for the publisher. There are no printing costs, there are no shipping costs. In the newspaper industry, there are paywalls, digital subscriptions, online advertising, all of which are growing much faster than traditional newspapers. Myth number 2 about News Corp. It trades on a huge PE multiple. If any of you pick up a stockbroker report and look at News Corp, the first thing you'll see is it trades on 25x earnings. So what are you talking about? I thought this stock was cheap. The mistake is that the stockbrokers don't consolidate the earnings that News Corp reports. A lot of News Corp's assets are equity accounted. When you equity account earnings, they don't come through into your PE. If you were to do that for News Corp, the PE collapses. Depending on your assumptions, you get a PE roughly half of the current PE. Myth number 3. Newspapers are worthless businesses. Newspapers, most people you speak to would say they should trade on 2 or 3x earnings. Well, I'm going to give you real-world examples that prove that's wrong. The Financial Times, which is a major competitor of the Wall Street Journal, just transacted at 9x EBITDA. The Wall Street Journal is a much better, bigger business and faster growing than the Financial Times. So if you put 9x earnings, which is the same multiple as the FT just transacted at, you get a valuation of $3.5 billion for News Corp's stake. That's 3 times the value implied of every asset on the right-hand side of the page, and that's just one asset. The next myth is that the market ignores the cash on the balance sheet. Murdoch, if he decided, could hand back 1/3 of the market cap to you in a special dividend tomorrow, and the company would still be undergeared. It would be on 1x debt to EBITDA. And the last point is that everyone believes that Rupert is not shareholder friendly. Now, it's true that it's quite amazing that an 86-year-old can have a longer-term time horizon than you. But it's true. Rupert knows he's going past 100. If you think about what Rupert inherited, which is basically a business that had one little Adelaide newspaper as the main asset, and he's turned it into a $20 billion fortune, which if he kept his Aussie citizenship would have made him the richest Australian today, he clearly knows how to create value. By backbetting Rupert, by staying in the vehicle, you get to buy an amazing set of assets at 1x earnings, an under-geared bulletproof balance sheet, and a business that's growing beautifully. And if you look at their last quarterly report that came out last week, they smashed earnings consensus. That's our great idea, and thank you for listening.
Thank you very much, Mark. Fantastic. So now our second last presenter is Jeff Felice. He's a member of the Cooper Investors Global Equities team, and he focuses on European and Japanese companies. He joined Cooper's, based here in Melbourne, in March 2014. Jeff starts most days with a surf near his house in Jeonjuk. Thank you, Jeff, and we also want to thank Cooper Investors. They're actually a fund manager in both companies, FGX and FGG. Thank you very much.
Thank you. Right. I'm going to present an investment today in a Japanese hidden champion. I'll start by providing an overview of hidden champions, discuss the major industry trends, and conclude with the key areas of value latencies. Hidden champions are small to mid-sized companies with highly focused business models that are hidden inside industry value chains. Often, they compete in a single niche product category, which they dominate. Hidden champions achieve these positions by selling mission-critical products that represent only a tiny amount of the overall cost base. They take a very long-term outlook, which allows them to invest significantly into R&D and talent. And by staying very close to their customers, they can take this R&D advantage and turn it into highly relevant product innovations. At Coopers, we think the most exciting time to invest in hidden champions is when they're exposed to tailwinds from global megatrends. And the stock I'm presenting today is a hidden champion of the digital world. The stock is a Japanese one called Hirose Electric. It's listed on the first section of the Tokyo Stock Exchange with the ticker 6806. It has a market cap of about 7.8 billion Australian dollars. Hirose competes in the electrical connectors market. Electrical connectors are crucial components in the digital world. If you take the device in my hand, at one level, it's an iPhone. But if you peel away the case, you'll find around 40 discrete components. These include the display, the sensors, or even the camera, like in the picture behind me. But for all these components to come together and create a unified product, they require connectors. And unlike the connectors a lot of us are used to, such as USB plugs, the internal connectors Hirose make are highly customized and they need to be highly resilient. And that's because unlike the apps on our phone, the components inside can't download an update to get rid of a bug. And for this reason, Hirose's customers are typically less price sensitive and they're more focused on quality and performance. The demand for connectors like this is growing rapidly, and we see the trends behind this all over our lives as more and more devices digitise and become connected. When we look to the automotive sector, we see this in the trends towards electric and eventually autonomous vehicles. And then we look at industry more generally, we see it in the trends towards factory automation and robotics. As a technology leader, Hirose is ideally positioned to benefit from this structural growth. Each time I visit Japan, Hirose's management team stands out for their ability to position Hirose at the cutting edge of technology and move themselves out of commodity areas. They generate around 1/3 of their sales from products less than 3 years old. At Coopers, we rank investment propositions based off the quality of the business model and the industry, the focus of company leadership, and the opportunities the company has to create value, which we describe as value latencies. Horose has two really exciting areas of value latencies around capital allocation and growth. Horose has significant excess capital with around 1/3 of the stock price underwritten by cash they have on the balance sheet. They can use this cash to buy back shares, they can pursue M&A, or it acts as downside protection in the instance of a major market sell-off. But I think the most exciting area of value latencies is around the growth initiatives being pursued by management as they push the business further into the higher growth end markets in automation and automotive industries. In summary, Horose provides an opportunity to get exposure to a Japanese hidden champion with strong tailwinds from the growth in digital devices. The management team have a material opportunity to create value through their growth initiatives, and around 1/3 of the stock price is underwritten by cash on the balance sheet. Thank you. Thanks.
Thank you very much, Jeff. A fascinating stock. Now, I'm sure we are saving the best until last. So last up, we have Matthew Haupt. He's the portfolio manager responsible for WAM Leaders and Century Australia at Wilson Asset Management. I didn't have to go far to get some tips on quirky facts about Matt, since I'm based at WAM and know him well. First up, he's a power lifter. He's a rev head. He loves McLaren Vale Reds. He's also an Adelaide boy. And if he wasn't doing what he is today, his other preferred job would be an SAS commando. How's that for a contrast? To take us out with the last stock pick for the day, here's Matt.
Thanks, Louise, for that introduction. I'm not sure where you got your facts from, but I'm gathering it's from people within my work. But I'm not sure about the SAS soldier thing, but we'll discuss that later. So the stock I'd like to talk about today is Origin Energy. This is a really interesting stock, and we still think there's significant upside here. The reason why we like Origin is it's a classic turnaround story. So if I wind the clock back, what went wrong at Origin? They spent $25 billion on a project which was returning 0%. That's probably a good start of what went wrong. So they invested all this money in an LNG plant, the oil price fell, LNG prices cratered, and they had over $13 billion of debt. The debt was higher than its market cap. So over the next few years, they began a process of deleveraging. So at the moment, the debt is around $6.6 billion, getting to a much more respectable level. And at Wilson Asset Management, we're always looking for stocks that have a turnaround story or a catalyst. So for us, Origin's quite simple. It's a deleveraging story. It's a cost-out story. They're going to start paying dividends again. And there's a whole bunch of fund managers that can't own Origin yet. The reason why they can't own it is because of the debt levels. So a lot of fund managers will have debt metrics where they're not allowed to invest in. So they look at the net debt to EBITDA ratio. For a lot of fund managers, the net debt to EBITDA ratio for Origin is too high. So they can't invest in Origin. So over the next few years, as they delever, Origin will become in their universe for other fund managers and they can start buying it. So we think there's a wave of buying to happen in Origin yet as these other fund managers come onto the register. And when we speak with Origin, they're saying a lot of these big funds are doing the work now. So we look at Origin at the moment. The last few days they came out with their Investor Day, a really positive update. So they've come out with $500 million of cost to come out of the business. They've come out with a saving on their debt. They've got very expensive hybrid debt, about $2.4 billion of hybrid debt. And if they refinance that through banks, that's about a $90 million saving. So you can see all these ingredients are really pointing towards a turnaround in Origin. And we think this will continue, and we think the Origin story is really strong. We think the new management, so one of the things we look for at Wilson Asset Management is CEOs and what they can bring. Frank Calabria, in our view, is very strong management. He's really focused on pulling cost out, and we think he's the right man for the job. So why can they pull out $500 million of cost? Basically, what they were doing when they were building the APLNG project up in Queensland in Gladstone, they were trying to get as much gas out of the ground into the project. And when you're doing this, you're not really focused on cost. You're just trying to get gas into the project to make sure it's okay and make sure you're going to get gas through the processes and out through the ships. So cost is not a focus. Now both trains in Gladstone are up and running. Gas is going through them. They can go back to all their fields and start to be more thoughtful around how they get the gas out of the ground. So at the Investor Day, the break-even cost for APLNG was $48. That's $48 of basically costs they have to incur before they make a profit. So at the Investor Day, they lowered the guidance for the break-even price of $40 by 2020. We think this is incredibly positive. We think that's conservative. We think they can lower this even further. And for every $10 they can save on the cost, on the cash cost, is around $300 million of free cash. So we think they can deliver faster than the market thinks. Also, you've got earnings growth within Origin. So the next 2 years, we forecast 70% earnings growth. So we think you combine all these factors, Origin looks really strong. If you want to paint a bull case, so you can run through scenarios with Origin. If you put in oil price $10 higher than it is now, and a $95 megawatt per hour electricity price, you can get about $14 from the stock. If you're a little bit more conservative, you could probably put oil up $5 and electricity price at $85 a megawatt. You'd be around $12.50. Current share price is $9. So we think all these ingredients make Origin a very sound investment case. Obviously, oil price is key here. So when we look at the oil price, we're looking at what OPEC do. So they're going to come out, it'll be in the next 24 hours, and hopefully there'll be an extension to the cuts from OPEC. So currently OPEC are trying to get the 5-year average oil inventory down to the, get the oil inventories down to the 5-year average. They're about 200 million barrels short of getting it down to the 5-year average. So we think they have to cut again. So the current agreement is to March 2018. We think this could be extended to the end of calendar year 18, and that's what we're hoping for. If this happens, it'll be incredibly bullish for oil, and Origin will benefit from that. So all those ingredients are pointing towards a really strong investment case for Origin. It's cheap in our view. It's trading at a below market multiple, but like I said, has 70% earnings growth over the next 2 years. A lot of people aren't even factoring in the valuation for APLNG, and that's where your upside is. Thank you.
Good afternoon. I'm David Leeton. I'm the Director of FGX, and I'm just here to wrap up today's session. I hope you all got something out of it. I did. So can we thank the 11 fund managers who presented their ideas today? So to have these fund managers share their IP, plus the time that they used in preparing it for today's presentation, is a real gift. And it goes beyond today. The 30 or so managers that we have managing the FGG and FGX funds, we've also got to thank them for the generosity, because remember, these guys don't charge fees, and this is what makes the Future Generations platform possible. The presentations that have just gone through is just a snapshot of the extensive due diligence our active boutique fund managers go through. And it actually then colours the way they actually make their stock selections. So I know firsthand the questions they constantly ask, the breadth, diversity of information they source and seek out to prove their investment thesis. It's really in-depth. For me, my paid job to know that these experts are managing our money is very reassuring. I also think the fund managers on the FGG, FGX platform get something out of it as well. Being on the rostrum is peer validation. peer validation of their reputation in skill in managing money. They all want to be associated with each other. I think that's really important. We, Future Gens, believe that we have an efficient platform for investing which is cheap with a philanthropic bent, whilst providing the investors with a broad and diverse investment universe with Australia's best fund managers. Can we also thank the WAM team for their ongoing support and tireless ongoing support, led by Jeff, Kate and Chris Stott, and those who worked on today's presentation, which were James, Alexandra, Natalia and Marika. Thank you. And lastly, I'd like to thank all of you for attending. To date, we had 950 people register for this presentation in here, and we also had 950 streaming. So that's a record for Future Generations. A reminder that our next investment forum is in Sydney on the 15th of May, and we're back here next year in November 2018. So thank you and good afternoon.